Welcome back to the deep dive. We are cracking open the vault today, taking a close look at what was really a defining year for Morgan Stanley, 2011. If 2008 was let's say, the heart attack for the financial system, these next few years were like the really tough, necessary rehab period. We're focusing specifically on the chairman and CEO's letter to shareholders. It's dated April 5th, 2012, looking back at 2011. Our mission really is to unpack how one of the world's biggest financial players navigated that immediate aftermath. All the regulatory changes, Basel III, Dodd-Frank, the Volcker Rule, how they pulled off a huge strategic pivot using their own words from this letter.
Yeah, and it's key to grasp that this wasn't just like shuffling deck chairs. This was driven by governments globally, basically redrawing the map for finance. They massively hiked capital standards to try and lower systemic risk. So for Morgan Stanley, the response had to be fundamental. A strategic imperative, really, to change their whole business model, moving away from those high-risk proprietary plays of the past and moving towards something more client-focused with a lower risk profile overall.
Right. And you see that tension immediately when you look at the 2011 numbers. They reported, what, $32.4 billion in net revenues?
That's right, and earnings of $4.2 billion, or 1.26 diluted share.
But, and this is important, the leadership straight up admitted these results fell short of expectations. And you, the listener, should get that this wasn't just a weak market, though that was part of it. It was also the direct upfront cost of taking these, well, pretty drastic actions to strengthen the firm.
Exactly right. They were paying a kind of stability premium, you could call it. This whole transformation really had three core parts. The first one was pretty painful, cutting off those high-risk activities. Specifically, they got out of proprietary trading completely, stopped using the firm's own money to make big market bets.
Okay, let's pause there, because that really hits the core of the regulatory push, especially the Volcker Rule part of Dodd-Frank. For our listeners, how do we explain the difference between that prop trading they ditched and the institutional securities business they kept and refocused?
It's a really critical distinction. Prop trading is the firm using its own capital, its own balance sheet, to gamble on market direction, hoping for those big outsized returns. The Volcker Rule aims squarely at stopping that, to protect depositors, taxpayers, from the bank's own risky bets. Morgan Stanley made a point of saying they were already consistent with the intent of Volcker. How? By refocusing their institutional business completely on client needs. They shifted more towards an agency model.
Meaning they act more like a middleman.
Precisely. Facilitating client trades, taking lower risk fees for that service, rather than taking on big market risks themselves.
Okay, that makes the de-risking very concrete. Ditch the betting, focus on the service. But to be genuinely lower risk, they had to show they had the capital, the cushion, to handle shocks. The letter says they ended 2011 with common equity and liquidity at the highest levels in their history. What did that actually look like in hard numbers?
Well, it looked like aggressively building up cash and reserves. They hit a Tier 1 common ratio of 13.0% under the Basel rules that were in place then. And they boosted their global liquidity reserve, that's basically their readily available cash pool, up to $182 billion.
13.0%. Tier 1 common. That sounds high. But what's the signal there? To the market, to regulators.
It signals serious defense. Remember, Basel III was coming, and everyone knew it would demand much higher capital levels. By hitting 13% before the deadlines, they were essentially telling regulators worldwide, look, we're not just going to comply, we're going to over-comply. That gave them breathing room, maybe even a competitive edge, even if holding all that capital potentially dragged down short-term returns.
Okay, and this is where the story really turns, I think. Shedding the legacy problems from the crisis era. The letter highlights two really massive actions in 2011 that shifted their capital picture. First one involves their big strategic partner, Mitsubishi UFJ Financial Group, MUFG.
Ah, yes, the MUFG conversion. That was a huge financial engineering move for the time. Essentially, MUFG had a large preferred investment in Morgan Stanley, and they agreed to convert that preferred stake into common equity.
Right, and that's the source of that $8 billion boost to common equity capital we mentioned. Now, let me just push back slightly here. $8 billion in new common equity sounds great for regulators, but converting preferred shares to common, that dilutes existing common shareholders, doesn't it? Was that dilution really worth the benefit?
That's the perfect question to ask. Normally, yeah, dilution is something shareholders hate. But in this specific context, post-crisis, needing to meet new rules, the regulatory certainty probably outweighed the dilution pain. First, it massively solidified the balance sheet in the eyes of global regulators. That was paramount. Second, and this is key, it eliminated a huge ongoing cost. nearly $800 million every year in preferred dividend payments they had been making to MUFG.
Ah, okay, so that $800 million drain on earnings just
Yeah.
stopped.
Exactly. It instantly freed up cash flow for the firm. So yes, there was dilution, but they traded that for eliminating a major expense and securing their regulatory standing. A necessary trade-off, you could argue.
It really shows that focus on long-term stability over maybe immediate share price bumps. And it's interesting, the letter notes the strategic alliance stayed strong afterwards, joint ventures in Japan, loan marketing in the Americas.
Yeah, it showed the relationship was deeper than just that one big investment. Okay, so the second major cleanup action was tackling what they called their largest remaining legacy exposure, the MBIA settlement.
Right, MBIA, the bond insurer. What exactly was that exposure tied to, and why was getting rid of it so vital for meeting those future capital rules like Basel III?
MBIA was deeply entangled in those, well, toxic mortgage-backed securities and other complex assets from the crisis. Settling with them meant Morgan Stanley could remove a huge cloud of potential future liabilities from its books. Specifically, it reduced their risk-weighted assets, or RWA. RWA is basically how regulators measure the riskiness of a bank's assets. The riskier the asset, the higher its weighting.
And the higher the RWA, the more carefully you have to hold against it.
Precisely.
Yeah.
So by settling with MBIA and removing that potential liability, they slashed their RWA significantly. The letter estimates it released the equivalent of about $5 billion in capital under the proposed Basel III rules. That's huge. It was like preemptively meeting a future requirement by shedding past risk.
So they bought flexibility. They got cleaner, freed up capital, ready for Basel III well in advance, which let them focus on clients even while, say, the European sovereign debt crisis was blowing up.
Correct. Though it's worth noting the letter includes a bit of caution. They supported the reforms generally, but they did raise concerns about how the rules were being written.
What kind of concerns?
Mainly two things. One, that the new rules might accidentally jerk off liquidity in really important global markets like government bonds, vital markets. And two, the classic worry that if you regulate the big banks too tightly, the risky activities just migrate elsewhere into the less regulated shadow banking system.
The regulatory whack-a-mole problem.
Pretty much. Okay, so with the legacy stuff largely dealt with and the capital base strengthened, Morgan Stanley could finally turn its attention fully to powering up the new revenue engines.
Let's start with institutional securities. The letter claims that despite all that market craziness, Europe, U.S. fiscal gridlock, they actually outperformed peers and gained market share.
It's a bold claim, but if you look at investment banking, there's some strong evidence. They stated they were, quote, unambiguously #1 or #2 in M&A and equity underwriting. And they backed it up. Ranked #1 in completed M&A globally in 2011. Advised on 8 of the top 10 deals worldwide. That's a significant market trust.
Yeah, it shows that even during all this internal restructuring, the big corporate clients still trusted them for the largest, most complex deals. They handled the year's biggest U.S. equity offering and the biggest global IPO, too.
Definitely retained client confidence there. And then you look at the sort of engine room, sales and trading. Equity sales and trading apparently surged, gained market share in cash equities, financing, derivatives, while many global peers saw revenues in those areas stay flat or even decline. This suggests that client-centric model was actually working.
And on the fixed income side, which historically could be prone to those big prop bets, they specifically mentioned transitioning to more stable flow businesses in rates and currencies. What does flow mean for the listener?
It means shifting away from making large directional bets on where interest rates or currencies are headed. Instead, you focus on handling a high volume of client transactions. You become the reliable platform clients use for their everyday business, earning consistent, albeit smaller, fees on each trade, rather than chasing those huge, volatile trading wins. It's less glamorous, maybe, but much steadier.
More predictable revenue. And while wrestling with Europe's issues, they were also looking east,
Right.
towards Asia, for long-term growth.
Absolutely. Strategic foresight there. They specifically mentioned launching their China securities joint venture Morgan Stanley Hawkson Securities, and also reaching an agreement to start an equities business in Indonesia. The letter flags Indonesia as Southeast Asia's biggest economy with dynamic markets, a clear strategic priority, planting seeds for future growth.
So institutional securities is one engine, powerful but still subject to market swings. The other key piece, maybe the stability anchor, was wealth management. The Morgan Stanley Smith Barney joint venture is called out as absolutely key to transforming the firm's overall revenue mix. Why was that JV so important to this new model?
Because wealth management is almost the textbook definition of stable, less volatile revenue. It provides this predictable stream of fees, and importantly, it's not very capital intensive, meaning they don't have to hold vast amounts of capital against those client assets under management. This steady income helps balance out the inherent ups and downs of the institutional securities business. It's the bedrock.
And the growth they were seeing and targeting was pretty stunning. Just in 2011, they pulled in $43 billion in global fee-based asset flows. That was a record for the JV at the time.
Yeah, that brought them close to $500 billion, nearly $500 billion in fee-based assets already.
But the goal they set, that was the jaw-dropper.
Doubling it to $1 trillion in fee-based assets within 5 years. Think about setting a target like that in the uncertain climate of 2011-2012. It really showed where they believed the long-term value was.
But achieving that meant huge operational lifts behind the scenes, right? The letter mentions integrating something like 17,000 U.S. financial advisors onto a single platform in 2012. I mean, moving 17,000 advisors and their clients onto one IT system during all this regulatory change. That sounds like a recipe for chaos.
Right.
How do they manage that without losing people? It was definitely a massive operational risk, no question. But it was essential to get the efficiencies the joint venture promised. The goal wasn't just smoother operations for advisors, it was about the bottom line. And they did show some progress. Margins in wealth management ticked up modestly from 9% to 10% in 2011. Doesn't sound like much, maybe, but on a revenue base that large, even a 1 percentage point improvement in margin means hundreds of millions in extra profit. It proved that the integration effort, however painful, was starting to pay off financially.
Okay, and quickly, asset management also seemed to be turning a corner after years of money flowing out.
Yeah, it saw positive flows again, $26 billion in 2011. The letter mentions good momentum in alternatives and liquidity funds, which were popular areas then. And performance-wise, it looked solid too. About 75% of their long-only strategies were beating their benchmarks over 3, 5, and 10 years. Helps the stability story bringing assets in and managing them well.
So if you tie all these threads together, the de-risking the revenue shifts, it comes back to discipline, doesn't it? Operational efficiency.
Absolutely. They mentioned setting up an office of reengineering. Sounds very corporate, but the goal was concrete. Find $1.4 billion in annual cost savings by 2014.
That kind of cost cutting is what makes the whole lower risk, potentially lower revenue per trade model actually profitable, right?
It's the crucial final piece. All those expensive actions, the settlement, the conversion, holding more capital they needed to show they could run leaner to justify it all. That $1.4 billion is the buffer, the efficiency game.
So when the CEO looks ahead to 2012 in this letter, the tone shifts quite a bit. There's this quote, "The to-do list no longer looks backward to fix problems. It looks ahead to capitalize on opportunities."
And that quote really sums it up for you, the listener. The implication is the really hard, messy, expensive part, the de-risking, is mostly done. Because they're less weighed down by those legacy issues and they're sitting on all this capital, they now feel they have the freedom, the flexibility to actually use that capital, to deploy it to support clients, win M&A deals, grow wealth management. They're shifting from defense to offense.
It really is a story about a fundamental reshaping of a business model, moving from that high-wire act of proprietary trading towards perhaps more predictable client-driven services. Beyond just the strategy and the numbers, what really stands out to you about this whole transformation they undertook?
You know, what I find genuinely fascinating is how it echoes the firm's origins. The letter actually makes this point. Morgan Stanley was created 75 years earlier, back in the 1930s, right after another massive economic crisis and regulatory overhaul, the Great Depression and Glass-Steagall.
Ah, interesting parallel.
Exactly. And the original mission then was basically to help industries get access to capital again, to foster growth, but in a trustworthy, client-focused way separate from commercial banking. So this new Morgan Stanley of 2011, by ditching the proprietary risk and doubling down on client needs, on collaboration, it starts to look remarkably like the old Morgan Stanley and its founding principles.
So a return to its roots, in a way.
It suggests that sometimes, maybe, the path to stability and enduring value isn't radical invention, but a return to core fiduciary principles. Focusing on what the client needs, not just what the firm can make for itself. It's a powerful idea.
A really fascinating thought to end on. That transformation can mean going back to your foundations. Well, thank you for joining us on this deep dive into how Morgan Stanley navigated that critical post-crisis period. We definitely encourage you, our listeners, to maybe dig a bit deeper and see how those plans, especially that ambitious $1 trillion wealth management goal, actually played out in the following years. We'll catch you on the next deep dive.